Gary Shilling, president of Gary Shilling and Company, has been making accurate predictions about the economy and markets for 4 decades. Gary remains skeptical about the recent rally we've seen in stocks. He, in fact, affirmed a target of 600 for the S&P 500 in 2009. He joins us now to discuss his outlook for stocks, the economy. We're going to talk about currencies and perhaps fixed income as well. Gary, always great to have you. Let us talk about this, though. We've seen a rally off the early March lows. A bit of it has come out, but the S&P 500 is still well above that 660 low it hit back, I think it was on March 6th. You think, however, that the S&P 500 could go back to 600? Explain why, because a lot of people are going to raise some doubts about that prediction.
Well, everybody has optimism in this country, which is a great thing. But this recession, I think, is going to drag on into next year, probably end about a year from now, and then followed by a slow recovery. We still have a lot of excess house inventories to get rid of. We've got financial problems, commercial real estate, credit cards, etc., on top of residential real estate problems. And, of course, consumers. There has to be enough fiscal stimulus, and we don't have enough yet, to break this cycle of consumer retrenchment, which means a lower production, more layoffs, less income, more consumer retrenchment. So we're a ways away from that. And in the meanwhile, the economy normally goes through fits and starts and recessions. We've had 11 recessions in the post-World War II period, and in 8 of them, including the current one, you had at least one up quarter in real GDP, and the stock market follows the same pattern. In other words, bear market rallies, but that doesn't mean the recession is over.
Okay, but you're not just sort of licking your finger and sticking it up in the air and saying 600. Explain to us exactly how you come to that number.
Well, we did as a matter of fact, in our May newsletter, it's called Insight, we did a careful analysis of this where we built some regression models, updated them from what we had a couple of years ago, and look at profit projections. And it's based on the usual suspects, corporate sales, in effect, productivity, labor costs, interest rates, and so on. And from that, we, in effect, forecast profits, and that gives us a $40 estimate on the S&P 500 earnings. And then if we put, that's for this year, and then if we put a generous, and I mean that's generous, 15 price earnings multiple on that, normally market bottoms it's more like 10 or 12, but 15, lower interest rates, maybe a higher PE is justified, 15 times 40 gets you to 600.
Okay, but Gary, at the same time, you know everybody's talking about these green shoots. They do see signs of an incipient recovery in the economy, even if you happen to disagree. They're looking beyond the $40 a share, even if they agree with it for the S&P 500. They're looking into 2010, and they say that if, in fact, the economy is beginning to hit bottom, we're going to see corporate profits rise in 2010. That would justify a higher level for the S&P 500. So tell me, what do you see happening to profits in 2010?
Well, first of all, those green shoots may be, as I mentioned earlier, simply the mid-course uptick in the economy, which is normal in a recession. As far as 2010, when we do get there, in other words, if you can look beyond the valley, and it may turn out to be more of a chasm than a valley that most people expect, but when we get there, I think it's going to be very slow recovery and slower growth really over the next 10 years. We're coming off a fabulous era, the 80s and 90s, stretch into this decade with a housing boom fostered by very aggressive monetary and fiscal policy. And I think we're entering a much slower growth period.
All right, Gary, stay tuned, because stick with us anyway. We'll be back with Gary Shilling in just a couple of minutes. He says the S&P 500 could drop to 600. We'll also look at Volkswagen and Porsche. Those merger talks on the rocks.
The course of the morning. We're back now with Gary Shilling. He has a bearish view of the economy and of the markets right now. He's with our Eric Schatzker on set in New York. And Gary, let me jump in and ask you a question. You mentioned as we head to the break that we're looking at a period perhaps of slower growth for the foreseeable future. Are you talking about a new normal for the U.S. economy for an extended period of time?
Yes, I am. You just mentioned State Street trying to get out from under TARP. Well, that's one of the reasons, one of the 5 reasons I think we have slower growth for the next decade. More government and involvement in the economy. We also have protectionism on the rise, unfortunately. That can slow or even cut off growth. We have the consumer on a saving spree for the first time in 25 years. That could knock 1 percentage point off of real GDP growth. And bear in mind, it grew 3.6% per year from 1982 to 2000. Those were the solid days. In addition, There's deleveraging in the financial sector. So you have a number of factors here that point to slower growth for an extended period.
Gary, I want to jump in and ask you, if you do feel like as though the prospects for the U.S. economy are that gloomy you just outlined, why is it at the same time that you have confidence in the U.S. dollar?
Well, because it's the best of the bad lot. The rest of the world is in worse shape. Ironically, when U.S. consumers cut back, the rest of the world, which is dependent on the U.S. consumer to buy the goods and services they can't sell anywhere else, are the big losers. For every 1 percentage point decline in consumer spending, our research shows that our imports, overall imports, declined 2.8%. That's almost 3-to-1 leverage. And the rest of the world has virtually no other place they can sell all these goods and services. So you look at China. Everybody thought 2 years ago, certainly, that China was going to hold up, even support the U.S. economy. What happened? U.S. consumer goes in the tank, and China's in basically what for them is a major recession.
All right, Gary, it's Peter here in Washington. We're going to ask Gary Shilling, if we could, to sit tight for another few moments with us. Stay through this break. We're going to continue our conversation with Gary Shilling, update you on all the day's top stories, and we come back here on Bloomberg.
Back now with Gary Shilling. He's been calling it right for 4 decades. In fact, in 1969, he was fired as the first chief economist at Merrill Lynch for accurately predicting the 1969 to 70 recession. Gary, you were just telling us, you were explaining to us why you feel good, at least, about the prospects for the U.S. dollar. You also have a favorable view on treasuries. And again, people are scratching their heads, saying to themselves, if the U.S. government has to go into this kind of debt to deal with this kind of recession, why are treasuries a smart buy?
Well, actually, I've got a bias there. I've been a bull on 30-year treasuries in particular since 1981, when I said we're entering the bond rally of a lifetime. They yielded 14.7%. They got down to 2.6% last year. Then they jumped up to about 3.5% and actually breached 4% recently. And I think right now, with the prospects of deflation, and that's where I think we're headed, I rather suspect we'll see lower rates. We're not going to have the big drop that we had before. After all, when you get to zero, you got to stop declining in rates, I think. But I do think there is further decline ahead, not only because of, in effect, no inflation, deflation, in fact, but also as a safe haven. I mean, you know, treasuries are the ultimate safe haven. That's where the world goes when they get scared. That's why treasury bills now are yielding less than 1%.
I'm going to give you about 30, 40 seconds to talk about junk bonds. A lot of people see junk bonds as attractively priced right now. Yields are still pretty high, but you're raising a red flag. Why?
Well, I think junk bonds, I think the big decline in junk bonds is probably over. The question is how quickly they are going to rally. There's going to be a lot of money made in distressed securities, junk bonds included. But it's really a matter for, it takes some very expert investigation to figure out which ones are going to make it and which ones are going to not. The default rates are increasing. They start off about 2%. They're probably headed for double digits. And it's a matter of knowing which are the winners and which are the ones that are going to basically cease to exist.
All right, Gary. Thank you so much for joining us. As always, Gary Shilling of Gary Shilling and Company, explaining to us why junk bonds aren't such a good idea and why the S&P 500 may drop to 600.